43. Investing is creating an opportunity for growth. The Millionaire Next Door, Thomas Stanley and Amp, William Danko. Investing is creating an opportunity for growth because it means using current resources to obtain greater value in the future. This process forms one of the fundamental pillars of economic and social development for individuals, companies, and even countries. Investing not only increases financial assets but also contributes to the realization of innovative ideas, the creation of jobs, and the improvement of society's standard of living. Therefore, investing is one of the most important tools for growth and development. At the core of investing lies the idea of using today's resources to generate greater returns in the future. For instance, when a company builds a new factory or an individual buys stocks, they are using their current savings with the aim of achieving greater profits in the future. This process triggers economic growth because investments increase production capacity, create new job opportunities, and support technological advancements. Therefore, investing creates an opportunity for growth not only for the investor or institution but also for society as a whole. Additionally, investing requires taking risks. However, when these risks are managed with the right strategies and analysis, they can lead to substantial rewards. Especially long-term investments offer significant growth potential over time due to the compound interest effect. For example, individuals who allocate their savings to long-term investment vehicles can enjoy a financially comfortable life during retirement. Similarly, companies can expand their market share, enhance their competitive strength, and achieve sustainable growth through long-term investments. Another important aspect of investing is its role in fostering innovation. The development of new technologies and the support of research and development activities are often made possible through investments. For example, when a tech company invests heavily to develop a new product, it contributes not only to the company's growth but also to progress within the sector and the broader economy. Such investments lead to innovations that raise the standard of living in society. In conclusion, investing is creating an opportunity for growth because it allows current resources to be used more efficiently and effectively. This process contributes to the economic and social development of individuals, companies, and nations. Investing does not only provide financial returns but also promotes innovation, increases employment, and improves the well-being of society. Therefore, investing is one of the most important tools for growth and development, and when managed properly, it creates significant opportunities both for individuals and for society as a whole. 44. The only true rule in the stock market is that emotions should not guide you. Market Wizards, Jack D. Schwager. The stock market is an arena where not only rational analysis but also human psychology is tested to its limits. The inherent uncertainty of the market, sudden fluctuations, and unexpected developments force investors to react emotionally. However, the common trait of successful investors throughout history is their ability to maintain calm without getting swept up in these emotional whirlpools. This is because when the allure of short-term gains overshadows long-term strategies, losses are often inevitable. For example, panicking and selling a stock when its value drops within a few hours could ignore the possibility of it recovering a month later. Therefore, controlling emotions is the most critical step in the investment process. The anatomy of emotional reactions, fear, greed, and delusions. The human brain is evolutionarily programmed to respond quickly to threats. However, in the stock market, these instincts are often misleading. Fear, especially during market crashes, drags investors into herd mentality. For instance, during the 2008 financial crisis, many people sold their stocks at rock-bottom prices, suffering significant losses. Yet those who remained patient during the recovery period not only recouped their losses but also made substantial profits. Similarly, greed pushes investors to want more. For example, during Bitcoin's sudden surge in 2017, many people invested at its peak, only to suffer significant losses when it crashed. These two emotions create a vicious cycle. Fear leads to missed opportunities, while greed causes unnecessary risk-taking. Another dangerous emotion is hope. Investors may hold on to a losing position, thinking maybe it will recover, leading them to unrealistic optimism. This can result in chronic losses. For example, an investor in a fundamentally weak company's stock may ignore the risk of bankruptcy while waiting for a miraculous recovery. Market psychology and herd behavior. The impact of emotions in the stock market grows not only through individual decisions but also through collective actions. Herd mentality is the tendency to mimic the behavior of the majority of investors. For example, when a stock is constantly in the media with positive news, investors experience FOMO, fear of missing out, and make irrational purchases. However, such bubbles are bound to burst when the price exceeds the real value. The dot-com bubble in the early 2000s is one of the most striking examples of herd mentality. Investors who blindly bought technology stocks without analyzing their fundamental value suffered major losses. Similarly, social media and financial gurus also trigger emotional decisions. Instant trends or rumors push investors to act without strategy. At this point, it is crucial to filter out information noise and focus on reliable sources. Solution: discipline, planning, and conscious awareness. 1. Creating a personal investment plan. The first step in eliminating emotions is having a predetermined strategy. This plan should answer the following questions clearly. What assets will be invested in, and with what level of risk? What technical or fundamental analysis criteria will be used in buy-sell decisions? What will be the stop-loss and take-profit levels? For instance, setting automatic sell orders when a stock drops 10% or exiting when a 20% gain is reached can prevent emotional interference. 2. Regular market education. Knowledge is the most powerful weapon against fear and uncertainty. Investors who develop themselves in topics like fundamental analysis, company balance sheets, sector trends, and technical analysis, charts, indicators, make data-driven decisions instead of emotional ones. Additionally, understanding the impact of economic policies or global events on the market helps maintain calm during panic moments. 3. Mind and risk management techniques. Diversification. Putting all capital into one asset increases emotional stress. Spreading the portfolio across different sectors, asset classes, stocks, gold, bonds, and geographies reduces risk. Meditation and breathing exercises. Taking a few minutes for deep breathing before making sudden decisions helps lower stress hormones and aids in clear thinking. Keeping a journal, writing down the reasoning behind each buy-sell decision helps recognize emotional mistakes and avoid repeating them in the future. For long-term perspective. Instead of aiming for getting rich quick, focusing on sustainable growth minimizes emotional fluctuations. Warren Buffett's famous quote summarizes this philosophy: "It's not greed that drives the market, but patience." For example, consistently investing small amounts, dollar-cost averaging, balances market volatility and reduces emotional reactions. Managing emotions is managing the market. Success in the stock market is more of a psychological test than a mathematical formula. Decisions driven by emotions may feel right in the short term, but they often lead to destructive results in the long run. Therefore, an investor's most valuable skill is the ability to control instincts like fear and greed. By leaving behind the noise of the market and sticking to your strategy, you avoid being swept away by the waves and row steadily toward your goal. Remember, in the stock market, the winners are those who never act on their emotions. 45. Success in investing comes from discovering the right opportunity at the right time. The Little Book That Still Beats the Market, Joel Greenblatt. In the world of investing, success is not only about finding the right opportunity, but also about combining it with the courage and discipline to act on it in a timely manner. Markets are constantly changing, economic cycles, technological innovations, or global events create new opportunities. However, to capture these opportunities, one needs not only good analytical skills but also patience and decisive action. For example, the real estate and stock prices that fell after the 2008 crisis presented a golden opportunity for long-term investors. However, those who panicked and exited the market during that time missed this opportunity. Correct timing is the key to minimizing risk while maximizing return. Identifying the right opportunity, analysis and forecasting. For an opportunity to be considered right, both fundamental and technical analysis must be used together. Fundamental analysis evaluates a company's financial health, its position in the sector, or the intrinsic value of an asset. For instance, a company with low debt and high profitability has the potential to appreciate in value over the long term. Technical analysis, on the other hand, determines timing by interpreting price movements and market psychology through charts. For example, buying a stock as it approaches its support level or selling at resistance levels can be a strategic move for short-term gains. However, opportunities are not always clearly visible. Sometimes sectors or yet-to-be-discovered technologies, which get overlooked in the noise of the market, offer the biggest returns. Peter Lynch's famous quote sums up this situation: "The best opportunities are hidden where the majority has not yet noticed." For example, the rise of electric vehicles was uncertain to many investors in the early 2010s, but those who understood the fundamental dynamics of the sector and invested early in companies like Tesla made substantial profits. The art of timing: act early or wait. Correct timing is one of the most challenging aspects of investing. Early investors may face losses while waiting for the market to mature, while latecomers risk buying into inflated prices. The way to overcome this dilemma is by balancing strategic patience with dynamic flexibility. For example, Amazon stock lost more than 90% of its value during the dot-com bubble burst in the early 2000s. However, investors who believed in the company's long-term vision patiently waited during the decline and increased their positions during the recovery phase. Today, Amazon is one of the world's most valuable companies. To get the timing right, the following steps are critical. 1. Follow macroeconomic trends. Factors like interest rates, inflation, or global trade wars determine the direction of markets. For instance, stocks tend to rise during periods of low interest rates. 2. Predict sectoral shifts. For example, the transition to renewable energy negatively affects fossil fuel companies but benefits solar energy firms. 3. Understand market sentiment. Contrarian investing, or acting against the crowd during times of excessive optimism or pessimism, aligns with Warren Buffett's philosophy: be fearful when others are greedy, and be greedy when others are fearful. Risk management. Is missing an opportunity worse than losing? The fear of missing out, FOMO, can push investors to take unnecessary risks. However, successful investors focus on limiting losses and letting profits run. This is where risk management tools like position size and stop loss come into play. For instance, when investing in a high-potential but risky opportunity, allocating only 5% of the portfolio ensures that potential losses are kept under control. Additionally, no opportunity is ever missed. Markets are cyclical, and similar opportunities will arise again over time. For example, travel stocks that plunged due to COVID-19 in 2020 began their recovery in 2021. Instead of acting hastily, waiting for the next wave is also a strategy. Opportunities grow in disciplined hands. Finding the right opportunity at the right time is just the beginning of investing. The real success lies in managing that opportunity with composure. Emotional reactions, excessive risk-taking, or giving up too soon can turn even the best opportunities into missed chances. Remember, markets reward patient and disciplined investors. Great profits are not made overnight but are the result of small, timely steps taken in the right direction. 46. The way to win in the market is to have emotional control. The most important thing, Howard Marks. Emotional control and success in the stock market. Achieving long-term success in the stock market is not limited to selecting the right stocks or performing technical analysis. Another equally important factor is emotional control. As Howard Marks emphasizes in The Most Important Thing, the key to winning in the market lies in making logical and strategic decisions without being a slave to our emotions. Why do markets move based on emotions? Financial markets are largely a reflection of investor psychology. One of the key factors determining stock prices is the decision-making process of buyers and sellers. However, these decisions are not always made logically. Investors often act under the influence of emotions such as greed, fear, excitement, and panic. For example, when a stock is rapidly rising, investors may buy at high prices due to the fear of missing out, FOMO. However, when a downturn begins, they may panic and hastily sell. These sudden and emotional decisions can lead to losses. The importance of maintaining emotional control. An investor who cannot remain emotionally balanced will continuously make wrong decisions in the face of market fluctuations. Stock prices will always be volatile in the short term, but companies that create value over the long term yield profits. Despite knowing this, many investors focus too much on short-term fluctuations and make poor moves. Howard Marks says that successful investors interpret what is happening in the market with their logic, not their emotions. As Warren Buffett frequently states, to succeed in the stock market, successful investors are those who are fearful when others are greedy, and greedy when others are fearful. Strategies to maintain emotional control. To prevent emotions from influencing investment decisions, some strategies can be followed. 1. Make a plan in advance. Creating an investment plan before entering the market prevents impulsive decisions. By setting your buy and sell points and investment duration in advance, you can act without panicking. 2. Clarify your goals. Focusing on long-term growth rather than short-term gains helps you stay resilient against market fluctuations. 3. Avoid constantly monitoring the market. Focusing too much on momentary price movements can trigger emotional reactions. It is healthier to check your investments periodically after making them. 4. Develop psychological discipline. Professional investors develop psychological discipline to manage their emotions. To avoid falling into the panic created by the media and your surroundings, you must stick to your investment philosophy. 5. Develop contrarian thinking. Instead of following the crowd, making decisions based on sound analysis and logic will make you a more successful investor. You can seize buying opportunities when the majority is fearful, and be cautious when the crowd is overly enthusiastic. Be smart and patient to win. Howard Marks' quote serves as a guide for anyone who truly wants to succeed in the stock market. Emotional control is the investor's greatest weapon. Investors who act logically, without falling prey to fear and greed, will be profitable in the long run. The stock market is not a game of emotions but a game of patience and strategy. If you want to win, you must learn to manage not only stocks but also your psychology in the market. 47. The stock market is a journey, not a destination. The Little Book of Value Investing, Christopher H. Brown. The stock market as a journey. While many investors enter the stock market with the dream of getting rich quickly, it is, in fact, more of a long-term journey than a race to a final goal. As Christopher H. Brown mentions in the Little Book of Value Investing, the stock market is not a destination, but a process. Achieving success requires continuous learning, refining strategies, and being patient in the face of market fluctuations. Why the stock market is a journey. Most investors view the stock market as a goal where they must make big gains as quickly as possible. However, this mindset contradicts the nature of the market. Creating value in the stock market is a process that grows over time, and those who progress with patience, not hasty decisions, are the ones who succeed on this journey. Seeing the stock market as a journey changes an investor's perspective. 1. Focuses on long-term growth, not short-term gains. 2. Makes strategic decisions instead of panicking. 3. Moves with patience and discipline. Success in the stock market is a continuous process. Successful investors do not just make a one-time large profit and retire. Figures like Warren Buffett, Charlie Munger, and Peter Lynch have viewed the stock market as a lifelong learning and investing process. As Buffett says, the stock market is a system where the impatient's money gets transferred to the patient. Therefore, for investors who wish to succeed, patience and consistency are more important than sudden, large gains. Strategies for managing the stock market as a journey. To achieve long-term success in the stock market, the following principles should be adopted. 1. Think long-term. Investors who enter the market with hopes of short-term gains will panic during fluctuations and incur losses. Long-term thinkers understand that companies will increase their value over time and they wait patiently. 2. Avoid reacting to sudden market movements. Short-term market fluctuations are inevitable. Panicking and selling or buying in excessive excitement can lead to mistakes. 3. Value knowledge and analysis. To progress on the journey, financial literacy is essential. Learning to read company balance sheets, understand market cycles, and properly analyze investment instruments is necessary. 4. Invest regularly and with a plan. Rather than making a one-time large investment, regular investments spread the risk. In long-term investing, harnessing the power of time benefits from compound returns. 5. Control your psychology. The stock market journey can sometimes be stressful. Learning to stay calm, understanding the nature of the market, and controlling your emotions will increase your success. Enjoy the journey. The stock market is more of a long-term discovery process than a set of short-term goals. This journey involves learning, patience, discipline, and strategy development. When investors begin to view the stock market as a journey, they can turn fluctuations into opportunities instead of fearing them. If you want to become a successful investor, enjoy the journey in the stock market and view each step as a learning opportunity. Because in the stock market, there is no final destination, it's an ongoing path. 48. Successful investors do not simply chase profits, they apply the right strategy. Common Stocks and Uncommon Profits, Philip Fisher. Success comes with the right investment strategy. While every investor's goal is to make profits, those who focus solely on money tend to fail. As Philip Fisher emphasizes in Common Stocks and Uncommon Profits, truly successful investors focus on applying the right strategy, rather than merely chasing profits. This perspective is one of the key differences that separates long-term success in investing from short-term speculation. The way to achieve profits is not by relying on luck or market fluctuations, but by consistently applying a well-researched and disciplined strategy. Short-term gains or long-term strategy. Many investors seek to make quick profits. Those who view sudden market rises as opportunities often believe that they can make big profits by frequently buying and selling. However, this approach frequently leads to negative impacts from market volatility and poor decision-making. Successful investors, on the other hand, view the market differently. They don't chase short-term gains, instead, they focus on creating long-term value. Rather than tracking every market movement, they invest in solid companies and wait patiently. They manage risks and build a balanced portfolio. At this point, Warren Buffett's famous quote serves as an important lesson for investors. Impatient investors lose money to patient investors. Strategies used by successful investors. If you want lasting success in the stock market, you must adopt the right investment strategy rather than resorting to speculation. Here are the strategies that Philip Fisher emphasizes. 1. Do in-depth research. Behind big profits lies thorough company analysis. Successful investors before investing in a stock. Examine the company's financial health, balance sheet, and income statements. Evaluate the management team and the company's growth potential. Analyze industry trends and competitive advantages. Philip Fisher's famous 15-point investment checklist also highlights the importance of in-depth analysis by successful investors. 2. Don't be deceived by short-term fluctuations. Prices in the market fluctuate constantly, but these fluctuations create opportunities for long-term investors. Successful investors focus on a company's real value without getting swept up in the market's overreactions. 3. Be disciplined and patient. It's important to stick to your strategy, not just create it. Key factors for long-term success are: not panicking and selling when the market drops, not giving in to greed during a surge in prices, investing in line with your goals. 4. Pay attention to your surroundings to spot opportunities. Philip Fisher emphasizes the importance of speaking with a company's customers, suppliers, and employees to identify hidden potential opportunities. 5. Develop psychological discipline in the market. Fear and greed sometimes dominate the market. Successful investors know how to control their emotions and assess market opportunities objectively. Set your strategy and stick to it. Philip Fisher's quote illustrates that success in the stock market is not a matter of chance but a matter of applying the right strategy. Investors who are driven by short-term profit often fall victim to their emotions, while strategic and disciplined investors achieve consistent gains. Instead of chasing profits, develop a good strategy and stick to it. Avoid emotional decisions and assess the market logically. The stock market is like a marathon. Success comes with steady, conscious steps. Remember, being the right investor is more important than investing at the right time. 49. To be successful in the stock market, one must understand the mistakes of others and take advantage of them. George Soros. The stock market is a place to learn from others' mistakes. The stock market is an arena where millions of people make decisions every day, blending psychology and economics. However, these decisions are not always rational. Many investors act under the influence of emotions such as fear, greed, panic, and overconfidence, leading them to make mistakes. This is where successful investors stand out. They recognize, analyze, and capitalize on the mistakes of others. Warren Buffett's quote summarizes this situation well. In the short term, the market is a voting machine, but in the long term, it is a weighing machine. In the short term, investors act based on emotions, which causes the market to become irrational. However, in the long term, the true value emerges. This is why investors who can spot others' mistakes and turn them into opportunities are the ones who profit. What mistakes do people make in the stock market? The most common mistakes investors make in the stock market include: 1. Greed and herd psychology. When a stock rises rapidly, many investors think, "I must not miss this train," and buy at a high price. However, the biggest gains are usually made not when the market is euphoric, but when fear is dominant. Successful investors, rather than following the herd, spot opportunities in advance. 2. Selling in panic and fear. When the market falls, many investors sell in panic, but this is often the wrong move. Smart investors take advantage of the sales made by those who panic. 3. Following the price, not the stock. Many people act without understanding why a stock is rising or falling. Successful investors focus not on price fluctuations but on the company's intrinsic value. For short-term thinking. The desire for quick gains often pushes investors into making poor decisions. Real gains come from patience and a long-term perspective. 5. Overconfidence and lack of information. Many investors take big risks with little information and end up losing. Successful investors conduct thorough analysis and manage risks. Strategies to turn others' mistakes into opportunities. Turn panic sales into opportunities. When the market falls, the stocks of strong companies can sometimes drop below their true value. During these times, investors who stay calm can seize great opportunities by purchasing quality stocks at a low price. Contrarian thinking. Identify the points where the majority makes the wrong decisions. Be cautious when everyone is buying, and be brave when everyone is scared. Focus on the company's value. Instead of price movements, analyze the company's financial structure and growth potential. Be disciplined and patient. Stay true to your strategy without falling into the mistakes of others. The smart investor is the one who reads the market correctly. To make profits in the stock market, you need to analyze the mistakes of others and know how to take advantage of them. Most investors make the wrong decisions based on their emotions. If you can spot these mistakes and turn them into opportunities, you will be the one profiting in the long run. Remember, your biggest competitor in the stock market is not others, but your own psychology. 50. Success in the stock market is understanding and managing risks. Moving against the crowd brings big gains. The most important thing, Howard Marks. Stock market success, understanding and managing risks. In Howard Marks' The Most Important Thing, he emphasizes that one of the most important factors for success in the stock market is understanding and properly managing risks. While many people focus solely on profits, successful investors develop a deep understanding of risk and learn how to control it. Although the stock market promises high returns, these returns can only be achieved with proper risk management. There is no such thing as a risk-free return. Every profit carries some level of risk. Risks in the stock market are inevitable. Factors such as market fluctuations, companies' financial health, external economic factors, and even investor psychology affect investors. Managing risk begins by being aware of these uncertainties. An investor must always recognize that they are taking on a certain level of risk when making an investment. However, the important thing is to manage this risk and know when to avoid taking risks. Howard Marks clearly states, investors think not only about profits but also about risks. Often, investors focus on short-term gains and overlook the risks involved. However, successful investors are aware of the risks, make timely exits, and align their investment strategies accordingly. Truly successful investors know that risk is not only about the possibility of loss but also about potential opportunities. Rather than fearing risk, they prefer to manage it and create opportunities at the right moments. Recognizing and managing risk. Most successful investors agree that understanding and managing risk is one of the most crucial steps to achieving success in the stock market. Markets can be volatile, and investors can make emotional decisions, leading to significant losses. Managing risk means knowing the point at which losses should be limited, knowing when to buy, and when to sell. Howard Marks emphasizes the importance of controlling risk, which requires investors to be well-informed and perform accurate analysis. Risk does not only come from external market factors, an investor's psychological state also plays a role in determining that risk. For instance, an investor who panics during a market downturn may sell at the wrong time, increasing their losses. On the other hand, taking excessive risks when the market is overly optimistic can put investors in a bad position. Success lies in being aware of risk and systematically managing it. A successful investor views risk from a broader perspective. For example, while some investors react to short-term fluctuations, successful investors focus on long-term strategies and goals. This way, they have the chance to see opportunities far beyond the daily market changes. An investor, when taking risks, correctly analyzes which risks will be beneficial and which ones are unnecessary. Moving against the crowd brings big gains. Another important point in Howard Marks' book is how moving against the crowd is crucial for generating profit. This is one of the most valuable strategies in the stock market. Most investors act under the influence of market psychology, which leads them to make incorrect decisions. People tend to buy more when the market is rising, hoping to make more profits, or sell out of fear and panic when the market drops. According to Marks, moving in the opposite direction of the crowd can lead to significant gains because periods of excessive optimism usually indicate that the market is overvalued, creating a potential bubble. Likewise, when the market is too pessimistic, stocks of valuable companies provide opportunities to buy at low prices. Contrarian investors are cautious during times of excessive price increases due to market frenzies but buy when the market is at its lowest levels. As Marks points out, the stock market rewards the patient and the brave. If everyone sees an opportunity, it's no longer an opportunity. This view is completely against the nature of the stock market. People often prefer to invest in popular and well-known companies, but when these companies are already highly valued, the return rate might be low. On the other hand, stocks of lesser-known but fundamentally strong companies can be bought when undervalued, leading to big gains. Successful investors do not follow the crowd. Truly successful investors are cautious when the market is excessively optimistic and seize opportunities when there is excessive panic. Going against the crowd is never easy because market movements are often based on emotional factors, and emotions make it difficult to make the right decisions. However, according to Marks, doing the right thing sometimes means not doing what's popular. An investor doesn't have to go against the crowd to achieve big profits. To succeed, one should not get caught up in the market's momentary craziness, adopt a value-oriented approach, and focus on the market's true potential. Spotting the mistakes of the crowd and capitalizing on them is the key to success in the stock market. Win by understanding risks and going against the crowd. Stock market success is achieved by understanding the right risks and managing them effectively. Going against the crowd means capitalizing on mistakes made by the majority of market participants. Investors who adopt this strategy can identify valuable opportunities that others overlook. Howard Marks advises investors to recognize risks, manage them with a rational strategy, and go against the emotional movements of the market. Remember, winners in the stock market are not those who follow the herd, but those who make the right move at the right time.